Stop everything you're doing right now and look at your screen. Because if you're holding Bitcoin, what you're about to hear will either terrify you or fill you with an unbelievable amount of hope. And which one it is depends entirely on you paying very, very close attention. We are witnessing a financial phenomenon unfold in real time, a classic battle between sheer panic and cold, hard, calculated opportunity. And by the end of this video, you'll know exactly which side of that battle you need to be on. The price of Bitcoin has just cratered to what many thought was an unbreakable floor, plunging below $92,000 and sending a shockwave of pure fear through the entire crypto ecosystem. Social media is ablaze with doom scrolling. The headlines are screaming about a market collapse, and a palpable sense of dread is forcing weak hands to sell in a blind panic. But what if I told you that this very moment, this exact point of maximum fear, is precisely where the most legendary buying opportunities in Bitcoin's entire history have always been born? What if the data, the real on-chain data that doesn't lie and doesn't care about emotions, is screaming that we are not at the end of a bear trend, but are instead hammering out a local bottom so obvious to those who know where to look that it's practically painting a picture of the rebound to come? Let's pull back the curtain on the real story. Because a headline price of $91,800 is a complete and total distraction from the underlying tectonic shifts that are setting the stage for the next explosive leg up. The first and most critical data set we need to examine is the behavior of long-term holders, the diamond-handed investors who have weathered storms far worse than this. While the price has been sliding from its peaks, the aggregate balance of coins held in wallets that have not moved their funds for over a year has not only remained steadfast, it has actually continued its relentless climb to a new all-time high. This is the single most important chart that no one in a state of panic is looking at. It tells a story of profound conviction. These veterans aren't just holding. They are accumulating, quietly and methodically scooping up the coins that the terrified newcomers are dumping onto the market at a discount. They've seen this movie before, in 2016 and 2019, and they know that this is the part where the smart money separates itself from the emotional money. This is not a narrative. This is a verifiable fact on the blockchain, an immutable ledger of who is winning and who is losing the psychological war. The second piece of our organic database focuses on exchange flows. Over the past 72 hours, as the price broke below 94, then 93, and finally $92,000, we witnessed one of the largest net inflows of Bitcoin onto centralized exchanges in the last month. On the surface, that sounds bearish, right? It sounds like people are depositing their coins to sell. And yes, a portion of that is exactly what's happening. But you have to look at the counterpart to that trade. For every seller, there is a buyer. And when we analyze the destinations of those coins post-purchase, a fascinating pattern emerges. The outflow from exchanges into what we classify as deep cold storage, newly created wallets with no prior transaction history, has spiked in perfect inverse correlation with the price drop. This isn't just shuffling. This is a fundamental transfer of wealth from short-term speculative accounts into the vaults of long-term believers. The coins are not disappearing. They are simply changing hands, moving from those who see a crisis to those who see a fire sale on a fundamentally scarce asset. This is a great consolidation phase, and it's a necessary, healthy process that strengthens the entire network by increasing its average holder conviction. Now, let's talk about the supposed catalyst of this drop, the outflows from the spot Bitcoin ETFs. It's true, we've seen a string of days with net outflows, and the financial media is having a field day with it. But this is where context is everything. The outflows, while noticeable, are a mere fraction of the monumental inflows we absorbed during the preceding months. This is a classic market digestion phase. After any massive, parabolic inflow of capital, a period of consolidation and profit-taking is not just normal. It is essential for building a sustainable foundation for the next move higher. The key metric isn't the one-day outflow. It's the fact that despite this wave of negative sentiment and scary headlines, the total assets under management for these funds remain near their historic highs. The structural demand story has not been broken. It has been paused. And this brings us to the most crucial call to action you will get today. I need you to be brutally honest with yourself. Are you looking at the same charts as everyone else, the simple line graphs of price, and reacting with emotion? Or are you willing to look deeper at the on-chain data that reveals the true flow of capital and conviction? Your next move will define your financial future in this space. So, I want you to hit pause right now, go to the comment section below, and type either conviction if you're holding strong and see the opportunity, or panic if you're feeling the fear. This isn't just for me. It's for you to publicly declare your stance and see the community around you. Then, smack that like button and hit subscribe, because in the next section, we are going to dive into the most powerful part of the analysis, the precise technical and on-chain signals that are flashing green and pointing to an imminent reversal that could catch the entire market by surprise. So you made the choice to look beyond the panic, to see the fear in the market for what it truly is, raw fuel for the next rally. Now, let's arm you with the hard evidence, the specific signals that are currently blinking green on the dashboards of the most successful analysts in this space. Signals that strongly suggest a local bottom is not just a hope, but a developing probability. The first and perhaps most telling chart right now is the MVRV Z-score, a sophisticated on-chain metric that compares Bitcoin's current market value to its historical realized value. After this drop, the Z-score has fallen sharply from its overheated highs and is now rapidly approaching a zone that has consistently marked prime accumulation territory in past cycles, a zone where the asset is fairly valued or even undervalued relative to its own long-term historical baseline. This isn't a guarantee, but it is a massive, flashing warning sign for anyone considering selling at these levels, indicating that the risk-reward profile has swung dramatically in favor of buyers. This is complemented by the Puell multiple, which measures the profitability of miners. The recent price decline has pushed the Puell multiple down from its peak, signaling that miner revenue in USD terms is contracting. Why is this bullish? Because less profitable miners are forced to sell their coin reserves to cover operational costs, creating a persistent, localized selling pressure. However, data shows we are not yet at the extreme lows that indicate total miner capitulation, which often marks the absolute bottom. But we are moving decisively in that direction. This suggests that while the worst of the miner-led selling might not be over, we are in the process of flushing out the weak hands in the mining sector, a necessary cleansing that removes a major overhang from the market and paves the way for a healthier, supply-constrained advance. Now, let's talk about leverage. The entire derivatives market just went through a violent deleveraging event. As price fell from 94 to 92,000, we saw over $2 billion in long positions get liquidated. That sounds terrifying, and for those who were over-leveraged, it was a disaster. But from a systemic health perspective, this is a resoundingly positive development. These liquidations were the source of the accelerated, almost parabolic downward moves. They forced the market to purge itself of excessive, dangerous leverage. The funding rates across major perpetual swap markets, which were persistently positive and high, have now normalized and even dipped slightly negative. This reset in funding rates is like releasing a coiled spring. It removes the structural imbalance that was making the market vulnerable to a cascade. With this leverage largely wiped out, the market structure is now significantly cleaner and more stable. A rally from this point is far more sustainable because it won't be immediately choked out by an overabundance of leveraged long positions waiting to get liquidated at the first sign of weakness. This creates a foundation of solid, spot-driven buying rather than speculative, debt-fuel froth. Then we have the short-term holder-spent output profit ratio, or STH-SOPR, which gauges the profitability of coins moved by investors who have held them for less than 5 months. This metric has dipped below 1, meaning that on average, these recent buyers are now moving their coins at a loss. Historically, when the STH-SOP recovers and climbs back above 1, it is often signaled that the local bottom is in and a new wave of profit-taking, the healthy kind, can begin. We are seeing the early, tentative signs of this recovery happening right now, in real time, as the market stabilizes around the $92,000 level. Finally, we cannot ignore the macro sentiment shift. The very reasons cited for this drop, macro uncertainty and ETF outflows, are inherently short-term in nature. The underlying fundamentals of Bitcoin have not changed one iota. Its scarcity is absolute, its network security is at an all-time high, and its adoption curve, from nation-states to corporate treasuries, continues its slow but undeniable upward trajectory. The market is simply catching its breath, digesting the historic gains of the past year, and transferring coins from impatient tourists to patient natives. All the data points to one conclusion. This is not a collapse. It is a correction of excess, and it is likely in its final, most painful, but most profitable stage for those with the fortitude to see it through. And this leads to my final, most important call to action. The information is now in your hands. You have seen the evidence that separates the amateurs from the professionals. The choice is yours to make. Will you be swept away by the tide of panic? Or will you use this moment of clarity to position yourself for the next leg up? Your journey doesn't end when this video does. The conversation is just beginning. I want you to go down to the comments right now and tell me one thing you learned from this deep dive that changed your perspective on this price drop. Let's build a community of educated, data-driven investors right here. And if this analysis brought you value, if it replaced your fear with a strategic understanding, then do me a huge favor. Smash that like button, subscribe to the channel, and most importantly, hit the notification bell. Because when the rebound accelerates, and the data suggests it will, you are going to want to be the first to know, armed with the knowledge to act with confidence, not emotion.